everyone. Today's the 31st of January 2017. It's about 5:26 in the morning. Just wanted to make a quick video. I received this email from a viewer, and this individual sent me a spreadsheet of his system, which is color coded here to blue, green, and orange. And when I received the email, I have just basically his daily performance on a given trade. So as you can see, there's a date there, and this is the system and the system result for every trade. And I believe the blue is two contracts. It has a two contract trade. This one is a one contract trade, and this one is also a one contract trade. So there's a difference in the contract size. And this one, he takes off the target. Well, first profit target is 6 to 8 ticks, and then he trails the rest. And this one has a risk reward ratio of about 1, and then a risk reward ratio of about 2 on this one, factor of 2. As you can see, if you're watching this video, I've kind of grown your all your columns to like I said, I'm going to do some number crunching. And really the lesson for this video is what I'm trying to demonstrate is which system is better, which system that you want to really pay focus attention to, and how do you analyze your daily performance. So I kind of did my own row column setup here to just so you can do a side-by-side comparison. And the whole total number of trades on the row column that I received has 236 total trades. And I first thing I did was I did the win-loss on each of the systems. So as you could see, this one netted a $13,360 profit. System 2 produced 3,612, and system 3 produced 7,449. So if I ask everyone that's watching this, which system would you pick, right? And most of you guys, probably including myself, would pick 13,360 just because it produced a lot more money, right? So but the game of the system is sustainability and stability of the long duration. So that's probably one key takeaway of the study that I just did is I did some number crunching, and I did a lot more data extrapolation based on the data that I received. So in this scenario, in this example, I calculated the win-loss ratio. So as you can see, system 1 produced 1.49, system 2 just a little less than 1.5, and system 3 is 1.9, right? Also calculated the statistical count of the trade performance. So as you could see, system 1 produced a 78% accuracy win. System 2 and 3, it's just hovering around 50%. So average ratio for the whole total, so I averaged all the loss and I averaged all the win, and I took the ratio of the two, and as you can see, the ratio got worse on when you average the life cycle of that data. So as you can see, system 3 is sticking out like a sore thumb. So basically it's almost near 2 to 1 risk ratio, right? Did similar to min-max loss. So I took the maximum loss for system 1, took the minimum loss for system 1, and similarly I did did it for system 2 and 3, and these are the results. So average loss throughout the whole sample, as you can see, system 3, even with one contract, is $153, while system 1 uh, produced a $515 of average loss. I did the same thing for the win. Um, so I took the max win and the minimum win, and then I averaged the two together. If you take an average P&L between the win and the loss, you could see system 1 has a ratio of 1, and system 2 is 0.67, and system 3 is 1.13, which is seems to be performing much better than the system 1 and system 2 together. So now the key, my question again is, which system would you pick? So if you're still picking system number 1, I'd like to maybe change your perception here by demonstrating data extrapolation. So what I did, it's going to be on the next spreadsheet, is I took the average loss, and the reason why for the average loss is that's the average of the whole entire sample, which is 200. So out of 236 trades that this individual took, uh, these are his averages throughout the whole sample, right? So what I did is I took this number and I took the average uh, win-loss ratio, and I extrapolated data based off of that too. And right now, his cumulative sum P&L curve looks like this, right? So as you can see, this one is in $7,000, $8,000 range, and the max of this one is around a little over 4,000. So if you're just looking at this curve here, system 1 looks very attractive, right? But when I extrapolated the the um, the number, the data number, or the average loss, and the risk reward ratio, and grew that number into 1,000 samples, here's the result. So what I did here is I basically I took I paste and copy the result of the system, right, which is all right here based on system 1, system 2, and system 3. So the first 236 data set is pretty much fixed, right? So as you can see, 236, it's fixed, right? So this is your current result. Now I extrapolated data, like I said, based on your P&L, or your win, your average win, and your average loss for all the system, and I took this risk reward ratio, and I created a random generator right here based on those two parameters, right? So basically, as you can see, if I scroll up here, so that's your entry, which is your risk, and then your risk reward ratio. Sorry, so that should be this is your risk, right? So what I did is I took those two and I created a random number generator based on those two parameters. So I'm tweaking. What I'm doing is I'm looking at your performance, and I kind of hit the fast forward button to generate the remaining whatever, to create 1,000 total number of points. So as you can see, I added another 664 data set to your current performance, and I kind of hit the fast forward button to see what the projected performance of your account based on the P&L, based on the risk reward ratio that you're taking per system. If that makes any sense. So I'm a very visual person, and and I actually plotted all of these row columns here. And so initially here, as you can see, this is your current performance to whatever data set you sent me. And as you can see, the blue line is looking more attractive, right? But if I fast forward it and I take 1,000 sample, which is what I created, any value or any data set past 236 is randomized with the given risk reward ratio. As you can see, system 1 actually did better, but the projected the projected performance is actually in the negative P&L now. As you can see, let's see, hold on, I'm going to refresh the button here. As you can see, this all the curves are moving, right? Um, you know, with system 2, even the risk reward ratio is high. It's just not performing as well as system 3. So in the long run, after 1,000 points of simulation, given that you don't deviate from your discipline, you keep the risk reward ratio. Whatever you're doing, if you just stick to the 2-to-1 risk ratio, as you can see, over 1,000 sample, that system 3 is a lot more profitable than system 1. And as you can see, the first 236 data set is not really changing, it's fixed. It's switching after a 237 data sample. Those are the randomized value. So as you can see, the longevity, in the long run, system 1 would be a slow loser, I guess. So the linear performance of it is still gonna come down. This is the cumulative P&L, and system 3 is the winner. So I would say that to focus on system 3, just because just the P&L alone, what I've demonstrated here is tweaking just the P&L, not the P&L but the risk reward, um, tweaking just the risk reward ratio of your system 3 shows a better performance throughout, in the long run, rather than system 1. Anyways, I this is probably all I can do on on the given data that I received. I just wanted to demonstrate that if you're kind of critiquing yourself, this is one approach that I always look at. I look at the overall system performance, and now I'm doing weekly performance, on a weekly basis. How am I doing this week? How am I doing next week? Or the week before that, and if you keep all these things in mind, it kind of puts you yourself on check. Is what I'm trying to say. So I think overall, you know, in my mind, um, even though these are one contract system, as you can see, you can still win trading one contract versus the two, um, as long as you keep the risk reward high. So I guess the key takeaway for this lesson is that um, keep your risk reward high on any given trade. So if you can take 2 to 1, 3 to 1, 4 to 1, that's pretty good. So actually, okay, so just for kicks and grin here, what if I change this risk reward to a higher number? Let's say, I don't know, 1, right? So let's see, 1 at 1. One's a little better, right? So as you can see, blue, now you're up in the see, I'm gonna bring this up here. You can just play with the, so one's a little better. As you can see, you're no longer on the negative. So what if I change it? I think the magic number is 1.7. So at 1.7 risk reward, if you keep your risk reward at 1.7, I believe you can take multiple sample, and as you can see, I'm just hitting the F9 key to refresh, and as you can see, now your linear curve just went. This is the model, right? The model of your trading performance. As you can see at 1.7, you're starting to see a good incline up to the upside. So if I lower that to I don't know, 1.5, so 1.5, it's still better. So I'll put 1. As you can see, if you do 1-to-1 risk ratio, now your curve is actually, you're now falling at a risk, you see. So if you focus on the system 1, which is the blue line, as you can see, you're barely breaking even, I think is what's happening here. So 1.5, it's just going higher, so it's better. And certainly at 2, I mean, at that point it's not comparable, just because this system 2 and 3 is 1 contract trading, and this one is 2 contract trading. So in any event, now is system 3 scalable? Absolutely. If as your account grow, your contract size would grow as well. So you can actually grow the account in that manner. So anyways, even if I do system 3, and let's just say you start growing your account, and let's just double this to 300. Let's just see what happens. So keeping the same risk reward, let's just say you double your contract size now, and you're doing your risk reward, and you basically, let's see, this one seems like it's a 2-to-1 risk ratio. So basically, it's a hit or miss. You either lose 300 or you make $600, right? So if I refresh that curve at 1.93, I mean, you can see the difference. It's like night and day. So anyways, that's it. The lesson learned here is, keep your risk reward higher, because in the long run, it yields a better result. So again, read my disclosure. Doesn't guarantee, this is just a hypothetical simulation. Doesn't guarantee results. So read my disclosure. It's always on all of my videos. So you take, this is taking your own risk. Anyhow, read the disclosure. But that's kind of my 2 cents on it. So all the other subscribers out there, if you're watching this video, if you have any questions, just stop on by and let me know. Until then, I'll see you guys on the next video. Take care and have a great one.